Hey, what's going on, guys? Due to artificially low interest rates and massive money printing, we might be in a global central bank's bubble. In this video, Raoul Pal will explain his prediction on banking bubble and exploit market opportunities. If we look at the S&P 500, it has a nice momentum built in since the sharp drop back in March, but it still was not been able to reach its all-time high from back in February 2020. As we know that the main driver of S&P 500 are predominantly giant tech companies such as Google, Facebook, Amazon, Apple, and Netflix, while other 495 companies aren't doing so well, especially banking sector. If we look at the BKX, which is a banking index that was designed to measure the performance of US companies in banking sector, and we can see that banking index is stagnant since the drop almost by 50% back in March when all this chaos began. But ever since it did not really do much, it has been fluctuating sideways until the current date, and I'm not surprised. It's very difficult for banks to generate decent profits in the 0% interest rates environment, since banks generate majority of their revenue by the difference between borrowing and lending. Suppose, hypothetically speaking, if you deposit your money in the bank and bank will pay you 0.25 APY, then they will take your money and lend them to someone else in exchange for, let's say, 2% APY. And banks generate the difference between 2% and 0.25% as the main stream of revenue. But since the interest rates are so low, the profit margins are suppressed. One of my good friends actually works for Bank of America, and during this illness he told me that they literally make no money, and they have no goals in foreseeable future. Considering the fact that we have cryptocurrencies and blockchain technology that can potentially add even more pain to banking sector. Now you can be your own bank if you choose to. In probably a decade or so, banks might become obsolete. Let's take a moment and see what Raoul Pal has to say about current market opportunities and banking bubble.
There's nothing going on. I mean, I was just going through a list. I mean, the S&P has basically been in the 3150, 3200 range now for over a month. I look at the BKX, it's kind of nailed at 17, it's been there since April. I look at Bitcoin, it's become so non-volatile, it looks like a two-year note yield now. It's not going anywhere, it's at 9,200. 10-year yields have been at a flat line at 62 basis points for as long as I can remember now. It's unbelievable. I mean, I've never experienced a time like it, but then I'm just staring at my screen next to me and on it I'm looking, wow, okay, so some things have moved. And if I look at what's moved, well, the gold mining shares, they're up 34% year to date. Meanwhile, the banks are down 35% year to date, or energy, which is down 39% year to date. Just a simple, sell oil, buy gold in terms of equity sectors yields you about 70% returns this year. I mean, so it's a weird world where nothing's going anywhere, but everything's going somewhere. It's, I've not seen anything like this. I've always been interested when you hear people like Stan Druckenmiller talk about this kind of stuff is, he's got two bets on, I spent some time talking about portfolio construction and how I look at trade ideas and stuff in the Ask Me Anything that I did this week for the Real Vision Pro tier. One of the things that, Stan Druckenmiller, he's got basically two bets on right now that he talks about. You hear him, if you filter all of the Stan stuff, he basically says he's long technology and he's also bearish on the central bank bubble. So there's basically a long bonds, long technology bet. And that bet, been a phenomenal bet for the last 2 years. Just that one simple bet, just getting the right bet is just a very good thing. Sometimes, however, things don't go anywhere. The only thing that really moved, otherwise, I mean, the dollar's sold off a bit, but nothing dramatic. I think gold miners are the only real action in town for the time being. And gold itself is okay, but it's been pretty much stuck at 1800 for a while as well. I think it's to do with central banks somehow suppressing volatility. There's no other real explanation why volatility. I think there's some sort of offsetting function going on between the lack of stimulus, but the existing, i.e. from the Fed balance sheet's not growing anymore, but there's fiscal stimulus in place, and it just seems to have stopped everything. I don't really know. I don't really understand why things have stopped moving. Now, it does happen from time to time. I never forget when I did a BBC show called $1 Million Traders back in 2008, and we filmed it over July 2008, and nothing was going on. And everyone was like, this is the most boring market in the world. And after that, suppressed volatility leads to hyper volatility, and the whole world blew up. And so it feels to me we're going to get some big moves. Which way? I don't know. We'll find out. I would be looking for I use the GMI crash pattern a lot. So it falls, it rallies, doesn't take out the high, and then takes out that previous low. It's something I talked about in the S&P. I've been waiting for that pattern to emerge, and it's not doing it yet. But that is a great signal and gives you a good chance to add risk into a trade. And then I go and zoom out and look at different time horizons and look for bigger breaks on weekly charts and stuff like that. And then you really start to add the opportunity for taking risk. So, risk is a function of where you are, the structure of markets, what your portfolio looks like. So, if you've got, because I've got gold and Bitcoin and dollars, they all kind of offset each other nicely, but I think they all go up, and bonds. And they all have that kind of interesting portfolio construct where they can all move around separately, but they all seem to be going together over time. And I like that. I'm very comfortable with positions like that. As you know, my thesis remains that we're going into a solvency or insolvency event, a solvency crisis, call it that. And we're seeing a lot of evidence of bankruptcies, credit card defaults, delinquencies across the spectrum, and the banks are provisioning. I think everybody, if I can give anybody a tip who's interested in this, just look at the price of the BKX, the banking index. It's been stuck around 70, but it looks very correct. It doesn't look anything like the rest of the market. It's telling you that there's credit problems. And I also look at the KRE, the regional banks index in the US, very similar, telling me something is not right here. I'm looking at the FTSE UK banks index, FTSE All Share, looks terrible. And obviously the European banks have looked terrible for ages, and the Japanese banks. Something in here tells me, whether it's CLOs or whether it's the credit markets overall, or whether it's the exposure to small and medium sized enterprises defaulting, or the public under financial duress, there is something still not good. And I know it's an incongruous world when I'm looking at the NASDAQ, it's up 22% year to date. But just remember, the banks are down 37% in the regional banking index. Something is going on here. And, I don't want people to lose focus on that, because, the honest is, as we started this conversation, there are opportunities from one sector to the other. If you think of gold being the most solvent thing in the world, it cannot go bust, it has no creditors, to the banks, which are the inverse of that. It's fascinating. It's a fascinating narrative in itself. And I've just finished an interview with a guy called Simon Dixon, who's kind of the kind of Bitcoin crypto world. He's a UK guy who got in really early, and fascinating guy. And his whole hypothesis that unfolded on the interview about money and central banks and the role that he sees of Bitcoin and gold was really interesting to me. There were some things I'd not really thought through. So we had a great philosophical discussion about some of the things that are coming and getting really close. But a lot of it, he came out the fear of, he still thinks there's something wrong with the banking system, the structure of it overall, that it's unlikely to survive all of this. What that means, who knows? His idea, and you still keep hearing it, is that these central bank coins may end up, Richard Werner talked about this in some respects as well, that the central banks become the bankers and the banks don't exist, and the fintech companies become the apps layer, which is essentially the banks now. There's a lot going on in this sector, and people need to really focus on it, because I know it sounds like it's all crypto, rah, 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 but there's actually a lot going on in the reality of it. And there's some rotting carcass within the whole banking sector.
As Raoul Pal said that Stan Druckenmiller, a legendary hedge fund manager, currently has two bets. He is bearish on central bank bubble, and another one is along technology companies. And it looks like it's a decent winning bet so far. We will see what will happen in the near future. In the late 1990s, we had the dot-com bubble, in late 2008, we had the real estate bubble, and now what it looks like, we're having a central bank's bubble. This central bank's bubble has formed thanks to the effort by several central banks around the world to boost their economies. Since 2008, they have used a combination of monetary stimulus, including setting low interest rates, even negative interest rates in some certain countries, and buying their own government bonds, and even buying actual stocks, i.e., printing money. Just recently, US central banks announced to buy corporate debt, which is essentially buying stocks. This has driven up asset prices worldwide. Due to all this stimulus, since the very beginning of lending, when you borrow money from someone else, they expect you to pay that loan back. Remember those days of 18% CDs in 1980s? However, many countries today were exactly the opposite. Very low interest rates, historically artificially low interest rates, lead to real estate bubble and stock market bubbles. That's because people can afford to pay more for the same assets due to the lower monthly payment from those low interest rates. The reason why real estate bubble often corresponds to rising stock market is that real estate prices rises, people feel good financially and often spend more money. Higher spending leads to higher companies' profits and therefore higher stock prices. Since 2008, to keep interest rates low, keep the market liquidity, and subsidize our banking system, the US government has bought $4.5 trillion in US government bonds. Prior to spread of this illness, not so long ago, they spent another $3 trillion and increasing its balance sheet to $7 trillion in total. And we are not alone in this stimulus strategy. The Bank of Japan owns approximately 70% of Japanese ETFs. And Switzerland Government Bank has over $88 billion invested in US stocks alone. Currently, more than a dozen of European countries have negative or 0% interest rates, including Germany, Switzerland, Denmark, and France. Japan has negative interest rates as well, and Japan has had zombie economy since 1990s. Another factor that could affect global economy is Chinese potential real estate bubble. China has built entire cities that are completely empty to stimulate its economy and keep its market moving forward. Regrettably, many Chinese cities are investing in wealth management products that invest in real estate and other speculative assets, which are like CDOs in America that got our economy in trouble back in 2009. Perhaps the biggest concern we have right now is Americans' aging population. Right now, every day approximately 10,000 baby boomers are turning 65, and this will continue for over 10 more years. These retirees will be turning on Social Security and Medicare and may be taking money out of the stock market instead of contributing to the growth of our economy. In addition, retirees typically downsize their homes and spend less on average than they did during the early part of their lives when they still were working. Reduced spending is bad for US economy because 70% of our economy is based on consumer spending. This aging demographic is a real potential threat to Americans' consumer spending-based economy. In addition to that, consumer spending was down by 13% in April alone. GDP numbers will be released in 1 week or so, therefore we will see what really happened in second quarter of 2020. Let me know, what do you guys think? Will banks become obsolete? Leave your thoughts in the comment section below, hit that like button and subscribe.